In this presentation, we will add customer deposits using bank feeds within QuickBooks Online. Here we are in our Get Great Guitars file. We're going to be opening up our reports. On the left-hand side, we'll be opening up the reports. We're going to be opening up the balance sheet. Open up that balance sheet, and we're going to be changing the dates up top in the balance sheet from 01/01/20 to 12/31/20. Going to run that report. We're going to right-click on the tab up top and duplicate that tab. Going to go back to the tab to the left, do the same thing for the P&L, going down to the reports at the bottom left. Then we're going to be opening up that P&L, that profit and loss, that income statement, changing the dates up top to the same range. Started in January, entering 12/31/20, and run that report. Then I'm going to go up top, right-click on that tab, duplicate that tab. So now I'm going to go back to the tab to the left. And we're going to then go to the banking section. And within the banking section, we're back to our bank feeds. I'm going to close up the hamburger here to see our bank feeds. Now we're going to be looking at the deposits. We have deposits that are left. Most of the deposits are going to be coming from the customer. Now deposits are going to differ depending on the type of industry we're in. The easiest way to think about deposits would be to think of them all coming from a customer, and that's what we'll start doing here. We're going to compare and contrast this to what we did in January, because you'll remember there was the same information that we entered into this QuickBooks system in January that we're entering now. So we'll kind of compare and contrast the results. But note that if I go back to our flow chart here, and with regards to deposits, we're just going to look at this flow chart to think of the normal process for deposits and customer transactions, the accounts receivable or income flow, and then think about how deposits would go into that practice. Note that if you're in some type of organization or some type of company, or your business is such that you do work and you simply get paid electronic payment for it, say you do services online or something like that, and you just simply get electronic transfers to you, and that's going to be your income, then it's quite possible that you can just simply record the deposit, be on a cash basis, and the bank feeds work perfectly for you, because you're simply going to be recording the work as you get the money, and that will be great. But if you're in a different type of industry in which you need to invoice beforehand, then you got to think about, well, how are the deposits going to fit into this? For example, this type of company, we have something set up where we're going to set it up kind of like billing for a law firm or a CPA firm or something like that, where we do guitar lessons or something like that, where we actually do the lessons for the month. We look at our time that we spent for the lessons, including the lessons and setting up the lessons, and then we invoice or bill the client with an invoice. And then we expect to receive a payment in the mail on it. Then we expect to go to the bank with that. So there's kind of 3 steps in this process. The question is, the bank is only going to have this last piece here that we're going to see. So how are we going to use the basic invoice process? How are we going to be using the received payments, and then recording the deposit at the end, which will be done by the bank? How does the bank feed fit into that? So we'll have more options on that. We'll think more about that in the second month, where we'll actually try to work in basically an invoice. Because how can you do that? If you want to use the invoice, you could use the invoice and then use the bank feeds, which will record the deposit. And you'd like to tie those two out. You want to match the deposit to the invoice some way. Or you could record the invoice, then record the received payment, which will put it into undeposited funds, and see if you can match out the deposit that goes into the bank to the amount of the received payment items. Or you could do the full process, invoice, receive payment, record the deposit. Then when you do the bank feeds, you're just going to match out the deposit from the bank to the one that you entered, so you don't have the duplicate, just matching those 2 transactions, just basically double checking those transactions. So those are the 3 methods. We're going to start in month 1 with the most simple kind of method. We're just going to record it when we get the money. So you might then use the invoicing process just to invoice, but not record the invoice in QuickBooks, because you don't want to record the transaction. You're going to wait until the transaction actually clears the bank. You're going to be dependent on the bank and not record the transaction until the end. What do you sacrifice when you do that? You're not able to track within QuickBooks the accounts receivable to do that. And when you get the deposits at the end of the day, you may not know who they came from. It may or may not be listed in the bank feed data who the deposits came from. We just know they're a deposit. So we don't have that added detail. We can't really look at who gave us the money and this and that as we can. And some, it just depends on how they show up in the bank feeds. Maybe it depends, how they regroup the deposits in the bank feeds if they're electronic transfers as to whether we'll have the customer name or not. But it could be quite possible that I just don't know who the deposits came from. I just know that they came from a customer. And so we'll lose some information if we jump right to a cash-basis system and be completely dependent on the bank. But it's the easiest thing to do, right? And the other way we can do a normal system is like if you're in a store, like a food truck store, you have the create sales receipt at the same point in time you do the work, and that would record the sales and the income, and then you go and make a deposit. So again, you'd have to think, well, if that's your type of system, how do the bank fees, which will record the deposit, fit into that transaction? And again, you might come to the conclusion that you want to record the create sales receipt at the point in time that you process the sales, make the deposit in the same kind of format that it will be in the bank statement, and then just simply use the bank feeds to match out your deposit to what cleared the bank. So we're going to start off in month 1 with just the easy method of just the cash basis. Anything that increases the bank that didn't come from us or a loan, a deposit, we're going to assume is a customer deposit, and we're simply going to record that to income, and we're going to wait till it gets to the bank, which means I'm not going to enter any invoice, I'm not going to enter any sales receipt, I'm not going to enter any received payments. I'm simply going to depend on the bank. And again, this is a really good system if you got electronic transfers, if you do work online or something like that, and you get paid in electronic transfers, and you're content to just record the income at the point in time that you receive it into the bank. So let's go ahead and go back over here. That means that this one actually came from the customer or came from us. The only thing we'll have to do in this system would be to determine if the money came from me as an owner putting money into the business. Hopefully that's not the case too often. Hopefully we're taking money out of the business after it generates revenue. And this one is a loan. That's another kind of exception. If it came from the bank, it's not income. We don't want to pick it up as income. These two down here are income, so those are the two that we're going to be picking up. So what I'm going to do is check this one off, and I'm going to say that we have a customer or vendor. And again, there is no customer or vendor because I don't know who it is, right? Because this deposit may be coming from multiple different people. Now, if you work on online transfers like Amazon or YouTube or something like that, and they're paying you in some way, then they may have that in the electronic transfer. However, if you're taking deposits and recording them into the bank and just putting them into the bank, then the deposit may not reflect then who gave you the money. And in that case, you're just going to say, well, it's a deposit, it's going to increase income, and we're not going to have that added detail of the customer. So it just depends how it will show up on the bank statement as to whether you can get that more detail or not on like cash basis systems such as this. So then we're gonna go down here, and I'm just gonna put it into an income account. So I'm looking for an income account, and so we've got equipment sales. I'm going to put it into the product income here, and we'll talk a little bit about the issue with the product income as well, because if we sell a product, we might be subject to sales tax, and that's going to be another kind of issue we want to just think over. What if we're subject to sales tax? If we're not subject to sales tax, then this system works really well. If you just have an electronic transfer or something like that, and it's an electronic payment, a service, you don't have to deal with sales tax, then you can do just a cash basis system without much of a problem. And then I'm just going to add that, and let's see what happens if we go to well, let's do both of them first, and then we'll see what happens. I'll do the same thing for the second one down here. This is going to be a 13192. I'm going to go in here. I don't have a vendor or customer. I'm just going to say that this is going to be income. So it's going to be going to income, and I'm going to put it into the product income. And then I'm just going to add that. Now let's go back over to the balance sheet. So I'm going to go to the balance sheet. I'm going to close up the old hamburger, hold down Control, scroll up a bit. We're going to go into the checking account. So I'll go into that checking account and scroll on down, and we're looking for the deposits that we made now. Here's one. Here's the other deposit. So if I go into there, here's the two deposits. If we go into them, it's not going to take us back to the prior screen, the bank feeds. It's going to go to a deposit. So whenever we have a deposit, it'll take us to the deposit screen. And here we have it down here, the 139,192. So I'm going to close this back out. And then if I go to the other side of it, if we take a look at the other side, it says it's going to the unapplied cash payment income. That's not exactly where we wanted it to go, so let's check that out. This one went to the sales and product. Let's go back into this one and take a look at the second half of this. It's going to the other account, unapplied. That's not the one I wanted to pick up. I wanted to pick up the sales of product income. Sales of product income, let's save and close. And then I'm going to scroll back up top and go back to our balance sheet. Now the other side is going to be on the profit and loss. So if I go back to the profit and loss side, close up the old hamburger, then I'm going to change the date up top just to show the 1 month, 03/01/20 to 03/31/20. Let's go ahead and run that report. And now we have the income side of things, right? So if I go into the sale of product income and scroll down, then we have our deposits down here. So there's our 2 deposits. The other activities is zeroed out up top. So we have our product sales and the other side of it going to, of course, the checking account. So there's the 2 sides of it. Note that if we're assuming that this is product income, meaning we sold products, we sold inventory, that we're not showing the other side of the product income, meaning we're not tracking the inventory in the system. Why? Because we already did that. If I go back to the income statement, you'll recall we basically recorded the cost of goods sold, the guitars in our case that we're imagining we're purchasing and selling guitars. So we're imagining that this is basically all, sales of guitars. So if we purchased and sold the guitars, we basically wrote off the cost of goods sold on a cash basis when we purchased the guitars, as if we're on like a just-in-time system. Like we purchased the guitars and turned around and sold them. We're not holding on to the guitars, in other words, would be the thought process there. And then we record the sales when we got the deposit, simply recording the sales price and the other side being the cash that we receive. Now again, this is more complicated than a cash-based system that doesn't have inventory. If it didn't have inventory and you had the cash deposit, just like an electronic transfer or something like that, then the cash-based system would be, obviously more simplified for that. If I go back into the sales item here and I change the dates from 01/01/20, we can compare and contrast this to transactions that we did in January and February in the full service process. You'll note down here that these deposits were from deposit forms. Up top, they weren't from deposit forms. They were from sales receipts and invoices, because that's the point in time on an accrual basis that we typically record this transaction. So if we're in the process of selling the guitar, typically we would make an invoice or a sales receipt, and then if we made an invoice, we'd make a received payment, and then we'd make the deposit of the item, of the deposits that we have received. In this case, we waited. We sold the guitar, but we didn't make an invoice. We didn't make a sales receipt. We just waited till the money cleared the bank and then recorded the income at the point in time that it cleared the bank. So and so that could work, but note what it leaves out the tracking and it leaves out the customers. Also note up top that when we're dealing with this, I have the customer name, who we sold to here, and I can track, sales by customers and things like that. Whereas down here, if I don't know the customer when I got the deposit, if multiple deposits are grouped together, all I know is its income, then I don't know the customer information. That, that's fine for the financial statements, but I'd like to know the detail of it. So that's kind of some of the things that you would be sacrificing on more of a cash-based system. Again, if you're on an electronic system for a service-based system and you work with, Google or YouTube or something, or Amazon, and they're paying you, then it might be noted in the bank feeds, and you could basically determine who's paying you for the services. But if you're replacing a full service system like this, then you could end up losing some information. Now, the next thing we'll take a look at is you might think about, well, what about sales tax? If I sell a guitar, then I might be subject to sales tax depending on the location, like the state that we're in the United States. How would I deal with sales tax? Because that's the other component of these items. If I had an invoice up top, if I create the invoice, it usually helps me to make the sales tax at the point in time I make the invoice. In other words, if I have an invoice here and I had the guitar that we sold, it tracks the guitar that's sold, it'll have the sales price to it, and it'll have the sales tax calculated for it, and that'll give us the total sales price. So what's happening with the invoice would be an increase to accounts receivable, an increase to the sales, but only by 500. The amount we charge, the difference between would be $47.50, which would be sales tax payable that we owe to the state, and cost of goods sold would be going down up, and the inventory would be going down. All happens with the invoice. We did all those in pieces, right? We said when we bought the inventory, the cost of goods sold was expensed, so the cost of goods sold went up when we expensed it. We're not dealing with inventory. We went right to the expense on a cash basis system. And then when we got, and then the income goes up when we get the money in the bank account, but it's going to go up by the full amount, the $547.50. And that means we recorded the other side to income at $547.50 instead of what it should be, $500, because we owe $47.50 if we're subject to sales tax to the state. So how would we deal with that if we had to deal with sales tax? And we'll talk about that next time. How would you, if you're on a cash basis system and you're using this kind of system without invoicing and whatnot, a more simplified kind of system, how could you work sales tax into it?